thank you for that fantastic introduction. So we're delighted to be with you today to talk more about the rails for tokenized finance. I know we've had a very high-level introduction there, but I'm just going to very quickly introduce myself and hand over to the panel to give you a little bit more information about them and what they do. I'm Sue Carpenter. I'm the Executive Director at Crypto UK. We're one of the UK's leading trade associations, looking after organisations that work in the crypto and digital asset space. We're very fortunate to also be partnering with another association called the Digital Chamber, who are one of the oldest and leading trade associations in the US. So we have a very unique viewpoint across both jurisdictions. I'm going to hand over to the panel just to give you a little bit of an intro on who they are, their companies, and what they do. So I'll start down at the end. Alastair, if you'd just like to go first.
Yeah, good morning, everyone, and thank you very much for having me. I'm Alastair Sewell, and I'm from Aviva Investors. There's two things I'd really like you to take away from this panel session today. And the first of those is that we are here. Aviva Investors is the investment management subsidiary of Aviva PLC. And Aviva PLC is the UK's largest diversified insurer. We are what you would call a traditional and significant institution. And we are here today to talk about this subject. And not only that, but my specific role within Aviva Investors, one of the many hats I wear in fact, is our tokenization lead. So we, as a highly traditional, highly institutional investor, are interested in the topic of tokenization and how that can act as a bridge to digital financial markets for us.
Fabulous. Thanks, Alastair. Anoosh?
Good morning, Digital Assets Forum London. I am Anoosh. I'm the Chief Product Officer at Zodia Custody. Zodia is a digital asset custodian, as you can tell by the name, and a digital asset wallet platform. Really keen to speak today and discuss a little bit about the infrastructure provider's point of view of tokenization, tokenized assets, and how we go about forming these rails and correspondences.
Thanks, Anoosh. Basil?
Hi, everybody. It's nice to be back in London. It's very sunny here. So my name is Basil Askari. I'm the founder and CEO of MidChains. MidChains is a digital asset trading platform and custody platform. We've been operating in the UAE since 2018 and have had regulatory licenses from almost every sub-jurisdiction within the UAE. But that's not our claim to fame. I'd say we're probably one of the few digital asset companies that has on its cap table two sovereign wealth funds, Mubadala and Lunate.
Fabulous, Basil. And Ed?
Hello, everyone. I'm Ed Felten. I'm co-founder and chief scientist at Offchain. We develop crypto rails. We are the original developers of the Arbitrum stack, which includes the Arbitrum 1 chain, a major DeFi chain, and also have helped now more than 100 corporate partners develop their own proprietary chains.
Fabulous. So as you can see, we've got a pretty broad and diverse panel here, and I think everybody's got some slightly differing views, although I'm sure there'll be harmony. We like harmony, but I think there'll be some really good discussions too. I think to open this up, I mean, it's a very broad topic and quite a closed question. Who owns the rails of tokenized finance? I guess we could also ask, why is that important? And what does that actually mean? And I think, Ed, when we were having an initial conversation, you've got some really good kind of descriptors and analogies as to this topic, and I think it would be great just to maybe start with your views on this.
Sure. What we're seeing at Offchain as we talk to teams about building out rails reminds me a lot of the early days of building out the internet's data rails. If you remember those days, there was one group of people over here who said everything will be completely decentralized and peer-to-peer. It will just be a bunch of home computers all running some protocol. And then over here you had people who said, no, what we need is a structure that allows capital investment, and that means it will be a single closed proprietary garden. And what we ended up with was something in the middle that combined most of the advantages of both of the extremes. We had an internet infrastructure, which is internet rails, which are proprietary, built and operated by companies. But on the other hand, they're defined by openness and standards so that people using different rails, people connected to different rails, can interconnect, and you get both the advantage of scale from being open and interconnected, but also the advantage of capital investment from being corporate funded. And we're seeing the same kind of thing happening with the crypto rails. I think what we're going to end up with is a set of a limited number of major corporate controlled and operated crypto rails, but defined by openness and interconnection. And so there'll be a few players who arrive early and make good decisions who end up in those positions of helping to operate that. But for end users, I think we'll have a system that looks like a single unified universe of opportunities, just like the internet does.
I think that's a really interesting way to describe that, actually, Ed. And just opening it up to the rest of the panel, I mean, does anybody else have any views on why this is actually an important topic to be discussing? So why does it matter who owns the rails?
I think it's very important for us to understand who owns and who should own the rails, because I think we could end up where we started, where essentially the clearing infrastructure that currently exists ends up owning the rails, and fundamentally nothing really changes.
Yeah, I'd agree with that. I think it is probably the most fundamental question, economic question of the day, as in who controls where that capital flows, who controls where that capital is. And this, yeah, I agree. It could end up we recreate what we have today, but in a new digital format. And if that would happen, it would be at its heart a sustaining innovation. Whereas I think what we're actually dealing with is a disruptive innovation. Now, that disruption will only work if the disruptors actually manage to execute and the incumbents don't resist that, and we recreate SWIFT, for example, on a purely blockchain basis.
Do we not think, though, as a panel, that it's almost inevitable, just seeing the pace at which the likes of SWIFT, the pace at which the likes of the settlement and clearing agents, the DTCCs, the Euroclears, how they're getting so involved? And, you know, we've heard many a time, this is not only about innovation by POCs, this is actually about innovation for the sake of utility, for the sake of large-scale volume. So do we not think it's inevitable?
I think there is a difference which might, and I hope will, operate here, which is that the crypto rails, as they're being built out, are mostly programmable. That means it allows people to build new functionalities directly on top of these rails that they do more than simply move assets. They allow people to develop more advanced functionalities and connect them together. So the smart contract or programmable rails, I think, are incredibly important, just as they were with the internet. You had the development of an entire application layer where people were building new types of services, and the really transformative power of it came from what people built on top of the basic data rails. The rails were the enabler, but it was the innovation beyond that really was revolutionary. And the barriers to entry into building new kinds of services were vastly lowered. One way of looking at what all of these rails can do if they're programmable is they might function as a kind of global shared back-end, back office functionality that startups, innovators can use without the need to build that very expensive and difficult to secure back office infrastructure. Now you have a set of public and publicly secured back office rails, and if they remain open enough and standards-based enough, we'll get the benefits of openness and reduced barriers to entry. But it's not a given that we'll end up with that.
I think that's a really valid point, Ed, and I think we'll come back towards the end of the session just to kind of look at where the optimal solution will be. But I think we touched upon the fact that obviously the panel have got very differing backgrounds, and obviously some of you are very operational in this space and you're dealing with these issues on a day-to-day basis. So the fact that we know where we should be going, we know where some of the concerns are, it'd be really helpful to understand, I mean, particularly, from Alastair, Anoosh, Basil, in your day-to-day work, the things that you're doing, where has this lack of clarity or this lack of ownership or this lack of the ideal solution caused any concerns or challenges? Are there any examples you can share?
One of the examples that comes top of mind is just legal clarity, right? If you look at traditional rails, you lose a stock certificate, the register issues a new one. If we think about digital rails, right, it's thinking about, well, depending on the jurisdiction you're in, who has legal title? How is that digital asset recognized, right? In what legal form is it? In the UK here, we're quite lucky, and I'd say quite advanced, and we really need to take advantage of that scenario. Likewise, Abu Dhabi as well, very similar position, right? We really need to use this to our advantage, but many other legal jurisdictions do not follow the same principles. So that is a clear area. I'd say another area as well is, I know the word is completely overused, but interoperability, right? How are you connecting together the private rails, the private tokenized networks with the external, the public, the scale, right? And we're seeing some solutions that are emerging there and that are gaining significant traction. But again, I constantly have to remind myself that we're still at the very beginning.
Yeah, I'd completely agree with that, and I'd probably add the word Ireland to your remarks, Anoosh, where Ireland sadly does not have quite the same property rights recognised for digital assets as we have here in the UK. I think there are a whole lot of other issues as well. I mean, we talk a little bit earlier about the back office and those sort of areas, that compliance layer, if you like. And this is going to be very, very difficult for institutional players like Aviva Investors to move away from, to move to new solutions, because compliance, AML, KYC, understanding our clients, complying with strict layers and layers of regulation in terms of knowing our clients, that is mission critical for us. So moving away from that to a more technologically based approach, which offers clear, tangible benefits, particularly when we think about the way you can program money. These are tangible benefits, but very hard for us to adopt because it is so hard to move away from that mission critical point that if there is a failure there, then that is not only a reputational risk, it becomes a strategic risk. It becomes very, very significant. So moving away from that and adopting this technology and the promise it can genuinely deliver, and we believe it can deliver, is organisationally a very big step to take. So there's a lot of moving pieces here. We have the regulatory piece, which Anoosh touched on. There's the organisational effects and the ability to move to a new paradigm. This is hard, and it will take time for big institutions like Aviva, like many others who you'll meet, incidentally, over the course of the next 2 days. There are many of my peers here. We encounter these challenges.
To build on what the fellow panelists have been talking about, in the UAE in particular, we do have very advanced tokenization rules and regulations. So one of the things that we've worked on as a company is to actually get an issuer license to produce tokenized financial instruments, which has been granted to us. We've not yet operationalized it. No one has in the UAE except for a handful of real estate companies, which is regulated separately. But to give some practical examples of where we're seeing challenges is in standardization across borders of regulation. I think that's one of the biggest issues and hurdles that we face. So KYC is not the same in Dubai, for example, as it is here. There are slight differences, and those slight variations can create big challenges when you're trying to deal with either takers or makers that exist outside of your home jurisdiction. The other thing that we're noticing and seeing is that there's a fundamental kind of rift in terms of tokenization of, okay, legally recognized ownership versus responsibility to manage the underlying asset that the token represents. And that often is missing, and we see that gap exist with some of the real estate tokenization platforms that operate. Without naming names, I would say the successful ones have the infrastructure to manage the underlying products as investments rather than as purely properties, while the ones that haven't been successful have just said, okay, let's fractionalize a title deed, let's sell pieces of it, then it's the owner's problem at that point. Some people may like that, but I think that creates more investor risk and potentially regulatory challenges in the future. So I think we have a long way to go in terms of aligning regulation, but what I would say is alarming to me is to see lots of regional banks trying to come up and develop with their own solution without talking to each other, where we're going to end up with too many solutions and we're not going to get anywhere with it.
Sure. One of the big changes we've seen in the technology requirements that we receive is much more emphasis on compliance, audit, and reliability. Companies really care about this. They're absolute requirements, and how best to integrate that into the technology stack, how best to integrate compliance into the rails, especially as you are building rails that are interoperable and programmable, is a core challenge, but it's one that I think we will manage. And as the regulatory picture and regulatory interoperability across jurisdictions starts to grow, I think the technology will be there. to support the compliance that is needed. And that's one of the big changes that we're seeing right now in the space, is compliance as a requirement, and a lot more of the technology focus being around the kinds of worries that people building back office systems historically have worried about.
I just wanted to come back and pick up on a couple of the points made there as well. Sorry, panel, if I'm going slightly off script here, but if this is complex, this is disjointed, and the interoperability isn't there, why is there an appetite from your organisations and the businesses that you work with to actually go down this route? Why do you want to move to tokenised finance? I suppose it's that question that goes, we know it's the future, we know we have to move forward with it, but if it's so complex, why is this an option that you're considering now, and what benefits outweigh those constraints?
Pretty straightforward from my side. We're a volume-driven organization, so more products means more potential volume, which means more business. Anything,
Alastair and Anoosh? I know you're obviously larger organisations as well, so what's the business case behind this?
Yeah, so the function I sit in within Aviva Investors is our money market fund capability. That's our core function. And in that business, we take in £1 billion, more or less, year in, year out, of new capital flowing into our funds. It's a great business. It does wonderful things for us as a firm. It's great. It's very traditional business. When you look at the opportunity set in money market funds worldwide, there's about $13.5 trillion worth of money market fund assets worldwide. You look at tokenized money market funds, there's about 12.5 billion at the moment. So you could look at that and say, well, that's a rounding error. Why should I bother? It's probably not even profitable because of the amount of input costs that need to go into creating a tokenized product and bringing that into new markets in terms of, and speaking from lived experience, you need to go through an awful lot of steps in terms of outsourced technology review, legal costs, et cetera, et cetera. These are complex projects for a traditional organisation to bring to market. So it really does make you ask the question, why bother? Really, why bother? Are we actually going to make any money out of this? And this is what makes it so interesting, right? Because this is the classic innovator's dilemma. We're facing a business which we have, which is great. We can invest more in it. We can listen to our customers. It will do well. It will bring in another £1 billion for us this year. It's a great business. Or we can spend a lot of time, energy, resource on this small niche area which has clients in it who come from a very different segment to that which we're used to dealing with. Why should we do it? And the reason we should do it is because none of us can predict the future. We don't know where the market is going to go. We don't know if any of these forecasts are right. But if we don't do this, we run the risk of being severely disrupted in our future activities. This is why it matters, and this is why organisations like us, like Aviva Investors, we need to be bold. We need to deploy capital into this. We need to learn, and we need to chart our path to avoid this risk of being materially disrupted in future. I personally believe tokenisation is an enormous opportunity. I think it's a bridge. It's not necessarily the biggest innovation we're going to see out there in the coming years, but it's the opportunity for traditional investment managers to mitigate that risk of being materially disrupted out of activity.
Anoosh, any thoughts?
I think Basil's provided a really good answer in terms of the infrastructure provider's point of view. It's a volume game, right? In terms of what Ed, also just to circle back to what you mentioned, right? This is all about back office efficiency. Think about the billions of dollars. Think about how much of an effort it is, how long we spent talking about the move from T+2 to T+1, right? Imagine atomic settlement. We're still quite a distance away. I'm realistic enough to realize that. I'm sure everyone in this room is as well. But think about the billions of dollars there. Think about the time. That says it all.
Fantastic, thank you. And again, just circling back to one of the earlier points, between the panelists, you touched upon a number of different jurisdictions that seem to be doing this well already. Is there anything specific across those jurisdictions that you think we should be learning from? Or is it just that their whole regulatory regime just seems better, more efficient, more thought out? I think just in terms of kind of if we were pointing the UK in the right direction, what should we be pinpointing in terms of the things that are going well elsewhere?
I'll reiterate exactly what Anoosh said. I think the Digital Property Act is a wonderful piece of legislation. If you haven't read it, I'd recommend you read it. It's all of about 11 words, in the Act, and those are 11 words of real significance, real value, because what they do is they enshrine the same rights for a physical piece of property as for a digital piece of property. We lack that in some other jurisdictions in Europe, notably in Ireland, and that matters because if you look at the mutual fund industry in Europe, it's largely, the major domiciles are Luxembourg, where they're onto blockchain law 4. There is recognition of digital property there, although different legal bases in Luxembourg to Ireland. In Ireland, that is currently lacking. We think it would be wonderful if Ireland were to move in that direction.
Completely agree, and I would say to add on to that, I think what we need to do is now build upon that strong baseline that we have and think about the practicalities and the ease of, maybe ease of compliance sounds like a bit of an irony there, but I think what we do need to realize is the timings, the cost in comparison to other regions, the cooperation between the regulatory authorities covering the various different asset classes and businesses themselves who at the end of the day simply want clarity and they want it quickly.
I think there's a couple of key hurdles that globally we still need to overcome regardless of how well written and well thought through the tokenization rules are between multiple jurisdictions, including the UAE. One is the concept of homogenized KYC and AML. I think because we have such different potential rules for these across different jurisdictions, even within the same jurisdiction across different types of licenses, it can create a lot of challenges in terms of moving assets between counterparties effectively and efficiently, or even potentially issuing new tokenized assets for various different projects, whether that's an RWA or some form of security. Where I think there's an opportunity here is to be able to think through these things and potentially work with the regulators to contemplate how, you know, all the onus of responsibility shouldn't sit necessarily with the infrastructure provider or the issuer, but rather it should also sit with the regulator in terms of creating that environment where if an asset is cross-border and international, that there is some predictability when it comes to its provenance from a compliance perspective, because otherwise we will have issues.
As a former regulator and now implementer, I really want to emphasize the importance of constructive and less transactional interaction between regulators and industry. That building joint understanding of how to move forward while meeting the needs and goals of both industry and the regulatory needs or regulatory goals is so important. There's no substitute for building some kind of mutual understanding, even if you have different goals.
I think just circling back to, again, one of the earlier points, I think a couple of comments were made across the panel where we were saying we just don't want to build another SWIFT. That's not going to work. I think what we're probably seeing, and you are probably seeing this a lot more, is that there is obviously a lot more interest now in these payment rails by the large TradFi incumbent players, and they want to get more involved in terms of ownership. It'd be helpful to get your thoughts on, is that a risky strategy? Is that a risky approach? If it is, why? And what should we be doing differently? Ed, maybe do you want to?
Sure. Well, is it risky? I guess the question is for whom, right? Change is always risky, especially when there's a lot of money at stake. At the same time, for companies that are in this space, I think Alastair described it well earlier, that it feels like a potential innovator's dilemma, a disruptive change that is coming. And there's a lot of value for being on board, if only because of the optionality that comes from having been there early, so that if this technology does end up becoming the main rails, that you're in a position, first of all, to profit from it, but second, to have some influence, more influence over how it develops. I'm a big believer that these rails are superior in the long run as we continue to build them out. But certainly, I think as a bet, it makes a lot of sense for companies in this space to be on board.
And you see there is quite strong evidence of early movers in these disruptive scenarios gaining potentially material market share in the future. And that equips them well to succeed in the future and to disrupt today's incumbents.
I'll jump in and talk a little bit about stablecoins because I like that. We kind of forget when we talk about tokenization that the real proven and successful use case that we've seen so far is the adoption and use cases across stablecoins, both for investments, but also for SMEs who are performing cross-border payments in a very cheap and efficient way. Not to say which stablecoin provider is I'm not going to talk about any one of them in particular, but conceptually speaking, I think what we really need to understand is that having that early mover advantage where the market share is given creates a adoption and a place where people can actually utilize those tokens properly. What I'm seeing, which is starting to become a risk in my mind, are too many new stablecoin issuers popping up. And so you'll have almost a micro balance sheet of stablecoins that are being issued from regional banks because they're now permitted to and they're allowed to in different parts of the world, including the UAE. But then, for example, if you are a user or a customer of MidChains and you want to redeem that stablecoin with the underlying bank, you have to hope that MidChains either has a relationship with that bank or you directly have a relationship with that bank. And it becomes a very convoluted way of going about and essentially taking your transit currency and going back into fiat currency, which is very difficult. So I think we need to be cognizant of that risk and understand that they're the ones that have already received the traction and been adopted by the market are likely not going anywhere unless there's some kind of catastrophic failure.
Yeah, and I'm quite interested to see how the next couple of years shape up, right? You look at the incumbents today who have undoubtedly been the innovators of their time over the course of the past 4, 5, even the past decade, right? And what I'm really interested to see is, obviously, if you think about the traditional institutions, they have the scale, they have the balance sheet, they have the pre-built networks, right? This has not been built over a day, a year, 10 years. This has been built in some cases over decades, if not hundreds of years, right? And one of the things that I think we should all be cognizant of and track really closely is what's the pace of change with respect to the traditional financial institutions? Are we going to see more consortium-like approaches which are gaining steam and which have been gaining steam over the course of the past couple of years? Will those will the scale itself replace the fact that the incumbents today with the technology, the know-how, the people experience have been the ones to take the lead? So I'll be watching the space closely. My bet is that we'll see the balance sheet at the end of the day winning, in the sense that the innovators of today will likely be bought out. They'll likely be merged together. We're going to see plenty of convergence, especially now as we look through. You can see some cheaper pricing in the market as well. I'm really keen to see how this all shapes up over the next couple of years.
Yeah, I think there's excellent points, Anoosh. And look, Aviva was founded in the 17th century, down the road in the Lloyd's coffee shop on Fenchurch Street. We have navigated successfully the advent of groundbreaking technologies like the telegram and the fax machine. We face a new technology to adjust to today. But on this specific question of stablecoins, we're really interested in stablecoins. We see a lot of use cases across the business. In the context of a mutual fund, we are specifically interested in the use of stablecoins as a means of subscription and redemption to mutual funds. We think that's really interesting, but that does pose a very important question, which is in fact your question, Basil, which is which stablecoin? Now, I can sit here and say, I, Alastair, have a view on which stablecoins are good. Can we, Aviva investors, point to an objective framework which we can validate, which we can test with third parties, and we can objectively use to identify which stablecoin is the most appropriate for us to interact with based on a number of risk-based criteria, so we can select objectively which one best meets our needs, which serves our clients' needs, and which mitigates all of the possible risks that we identify associated with this. So I think this is going to be a really big question that institutions are going to grapple with is, yes, we should onboard this technology because we see future potential benefit. But when you start getting into the reeds, you have to think really carefully, really deeply about how you do this, how you validate what you're doing, and how you step forwards aggressively, but also prudently and with conservatism.
Thank you. I never like to end on a negative. I never like to end on a position where we don't think that things are working. So it's always a good way for me to kind of sum everything up at the end, to get an idea from the panel as to what does good look like without sounding cliched. If we had the payment rails that would work for you in terms of compatibility, interoperability, what would be the benefits of that? What would it look like? And how do you think we could actually achieve that? Basil, I'm going to come to you first. I think when we chatted, you had some interesting points on this.
So one of the reasons I got into this space, I used to be in private equity actually, is to find ways to make private market liquidity more efficient. This is something that we're seeing on a regular basis every day, and one of the reasons why I keep getting up and going to the office. So going forward, what we're looking to implement with our licenses is to actually create an opportunity for market participants to come and create a vibrant private market of tokenized assets to be tradable. Now, those could represent individual assets, funds, whatever they may be, but they would have to meet our risk criteria, which is being defined as we speak with the regulators, which is great. So I think that's an extremely positive note, and I do see some of these assets coming to market before the end of the year.
Anoosh, do you maybe want to just add what the future looks like in your utopian world?
I'll go back to what Basil actually mentioned earlier in terms of KYC, right? And the arduous process that it is today for each and every single regulated financial institution or virtual asset service provider to go through with each of their clients, right? And you think about the opportunities there to make that more programmable, right? There's plenty of, there's actually quite a few use cases that are going on in that space, thinking about how can you make this programmable? How can you make it transferable? How can you avoid the inefficiencies of all of these hundreds of people hours going into these kinds of scrutiny? The other area I'd also look at is just thinking about interoperability, right? We didn't mention tokenized deposits today, but thinking about how we can connect together all of these fragmented chains which have liquidity scattered across them, and how we can actually abstract away from any one given chain and think about instead how are we providing the most efficiency, how are we providing the most throughput, and at the end of the day not resulting in any kind of liquidity crunch, right? The user themselves, if you think about the end users, if they're not looking at speculation, they don't really care about what chain it is, right? They need to have all of this abstracted away. It should just be like any other asset. The underlying rails itself is the plumbing, right? So my utopia looks like a really simple, abstracted view that at the end of the day has plenty of redundancy and is super connected.
Thanks, Anoosh. Alastair?
I think my future, our future, the future for Aviva and Aviva investors is the journey. And for us, that journey is going to start with tokenized money market funds. Now, you asked to finish on an upbeat note. I did accuse tokenized money market funds of being a rounding error earlier. But if you look at it from the other direction, you'll see that tokenized money market fund assets grew 120% last year. That's big growth, and that is new capital, which is coming from new sources, and that is proving the case that this is an industry that is going to develop and grow. We see all kinds of forecasts. We assume most of them are going to be wrong, but we do think there's potential here, and it is incumbent on us as a provider in that space, one of the largest in the UK, in fact, to step forwards and embrace that future and embrace that journey and all of the twists and turns it will almost certainly have.
And Ed, you're the man that can probably make this happen. No pressure.
Or help work with, I hope, many of you. I think this utopia looks like a few things, and several of them have been mentioned by the other panelists. It is very low cost of operation. It is very fast settlement, T plus less than 1 second. It is user experience that feels natural, and where much of the headache of finance for ordinary people, it can be abstracted and managed in a trustworthy way. It is enough regulatory harmonization and the build out of compliance. And then finally, it is the emergence of standards and best practices that enables trust, so that people, end users and institutions trust the technology, and the technology deserves the trust.
Fantastic. Look, I think it's been a really interesting discussion, and I'd like to thank all of the panel for their time today, and thank you all for taking the time to come along and listen. I know you're all going to be here for the rest of the day, so if anybody's interested in having a conversation with anybody here, please do come and find them, come and talk to them. I'm sure they'd be very interested in having a much more detailed conversation with you on some of the matters we've discussed today. But thank you all. Thank you to the Digital Asset Forum, and thank you, panel.